Good afternoon. Welcome to our first webinar. We're going to wait just a little bit longer so some other people can log in. Thanks for the people that are already here and have already logged in and wanted to join us today. I'm sure you're all having a great time here baking this 116-degree heat. I thought we were actually kind of past that for a little bit, but it came back to bite us here. So stay in your air conditioning, for the next few days, and I think you'll all be fine. So, okay, I think we'll get started. We seem to have enough people on. Like I said, welcome to our very first webinar, Building Your Assets Without Touching the Markets. What I wanted to point out was that in the month of June, the stock market went up about 1,000 points, then back down about 1,000 points. And then the first part of the July, the market went back up about 1,000 points again. So this is a roller coaster ride that many investors are not really comfortable with. So today we wanted to share with you some ways to reduce the volatility in your investment portfolio and still position yourself for an acceptable expected return. So first, a little background on myself and my firm. I've been practicing financial planning, investment management for 17 years. I have an MBA in finance. I've been awarded all the top 3 industry certifications, a certified financial planner, a chartered financial consultant, and a certified life underwriter. I'm also a registered investment advisor. I focus mostly on retirement planning, which is typically the primary reason that people save and invest money. And I work independently, which allows me to focus exclusively on my clients and their unique individual needs instead of trying to operate a large firm. First, a few important disclosures that I'm supposed to give you. The information here is intended for educational purposes only. We believe it all to be reliable. We can't guarantee that it's completely complete or accurate in every degree. The views and opinions analyses expressed here are my own, Southwestern Retirement, and not those of the Independent Financial Group, which is the broker-dealer that handles my compliance. The material is not intended to be construed as tax or legal advice. Always consult a tax or legal professional for details regarding your specific situation. And if you don't have one, I can certainly help you find a very competent one. My practice focuses on 5 primary areas: retirement planning, we talked about, tax planning, risk management, estate planning, and today's topic, investment planning. Before we get into the heart of today's discussion, I want to direct you to our new interactive website. It's a great resource where you can find a lot of useful information and guidance to help you get a better perspective on your financial planning situation. In my long experience in talking to people about financial planning and investment management, I've found 3 general approaches. First one is ignore the issue and hope for the best. Seems to be the most common, but probably the least effective. Followed by trying to do it yourself. But the method and the professional approach to it can be difficult for people, or don't do this all day, every day. And third way is to hire professionals to do an expert job. And that's part of what we'll be talking about today. So when you're hiring a professional, you get 3 things. One is a clearly defined strategy, which is quite an advantage when you're approaching these things, but also a detailed and proven process. I've done this for maybe hundreds of people now so far. But we also have access to the best professional level tools for the job, which makes it a lot easier for us to come up with solutions that are useful to you. The diagram here, I'm not going to go into it in great detail, but it shows a general investment strategy that we use. It's also used by many other experienced investment advisors. Clearly defined investment strategy, you should be able to identify which of your investments are allocated to each category and why. These allocations should be determined with respect to a well thought out and organized personal financial plan. Next one here is a lot of detail on here, but it's a diagram of a well thought out and documented investment policy. We do publish investment policy statements before we start to work on people's portfolios. It's the first step here in the investment policy process is actually defining and determining what your investment objectives are, which will come from analysis of your personal financial plan and determine what's appropriate for your own financial situation. Second step is determining your risk tolerance, and it's the basis of how we choose investments. The third step is choosing a portfolio strategy and how we address managing that risk tolerance and your investment objectives, which we'll address specifically today. So let's talk about risk a little bit. Go back one. The old way of assessing risk is stereotyping investors with subjective semantics like aggressive, moderate, and conservative. It really doesn't work that well. You really can't put people in boxes that way. What we found with the research in the industry is that about half of 20 to 29-year-olds in that category really are not aggressive investors, and more than half of older investors in 70 to 79-year-old category really aren't conservative. So this really doesn't work that well. We like to individualize the risk analysis for each client because they have unique and special needs. So we use a risk number. It's uniquely determined for each client. Yes, you have to take a test, but it's a very quick test, and it's a quantitative way to pinpoint how much risk that you're really comfortable with taking. With that, we also can assess how much risk you're actually taking in your current portfolio, and putting that together, your financial plan, get an idea how much risk you need to take to reach your financial goals. All three of those should be aligned, but they're always different for every individual client and situation. So it's very specific to them based on their personal situation. So going through this quickly, key question here is how much risk do you want, or how much risk can you handle over the next 6 months? So what we do is we run you through a scenario where we determine how much you're willing to lose in exchange for how much what the opportunity is for a specific gain. So then we can start to gauge what your tolerance for risk and investing truly is. So how much risk do you really need is really what objectives are we trying to hit at your retirement and throughout your retirement, the income that you'll need in retirement. But we have to back calculate how much risk in your portfolio that you'll take to hit those numbers and what the probability of that success would be. And the last part is how much risk do you actually have? And this is where it gets pretty interesting when we're working with clients and they bring in a portfolio or a portfolio that we've already put together for them, and making sure that what they're invested in actually matches. If there's a big difference in between the risk that they have in the portfolio and what they really are comfortable with, that indicates that we probably need to take action to rebalance that portfolio to something that's a little more appropriate. So now we'll get into the meat of the presentation here, and we're going to be talking about reducing investment portfolio volatility. Why volatility? Well, it's accept and measure portfolio risk. Our concept here that we're talking about is getting beyond the stock and bond markets, so we don't have to deal with the volatility in those markets. We find that non-traded investments, which means investments that aren't traded in the market, are for the most part less volatile, but they also can have regular income distributions. They can have tax advantages. One of the disadvantages is it can be somewhat illiquid, but we also want to watch out for the expenses on these as well. So investment idea one. We've been working with market link certificates of deposit. We call them MLCDs. What this is that the yield is based actually on a market index performance and not on a low fixed rate that you'll see in a bank. So a typical index or mixed indexes would be, say, the SP 500 or maybe the general world market index for stocks. The thing is that these are principal protected. There is no market downside. So if the market does take a crash, which everybody is quite concerned about, you preserve whatever money you put into it. So there is no market downside for you. They are FIDC insured, just like a regular CD would be at the bank, but you can hold these in your brokerage account. Second idea we want to talk about is real estate investment trusts. It's probably the most common alternative investment, but it's actually difficult for average investors to get access to quality investment properties unless they join together with other investors to pool resources to buy these properties. They're often large portfolios of properties. They may have specific themes, such as Class A office buildings or very large apartment complexes. They have distributions that are paid monthly or quarterly. There is some tax protection to them because depreciation of the property passes through to the investor. But they are illiquid. A typical hold period is 5 to 7 years, even though from time to time they may be able to redeem some shares. Potential inflation hedge. Real estate is very often used as a hedge for inflation, which is also a big concern in the markets. Investment idea number 3 is our fixed annuities. These are very low risk to the principals. There really is no volatility to them because they have a fixed return and fixed maturity. They're very predictable. Since they're in an annuity wrapper, they do have tax protected accumulation. You're taxed when you take the money out. They do have some income benefits to them. We also use them a lot because since they have multiple maturities, different years, 2, 3, 4, 5, 7 years, we can ladder these and target returns of certain amounts of money in certain dates. So that becomes very useful in the cash flow planning process. Last one's a little trickier. Private debt placements offered to qualified investors only. These are usually portfolios of loans placed with medium-sized companies that are too big for a bank loan, but too small to go into the bond market and do a bond offering. One thing that's nice about them is that they're usually variable rate loans. So if we start to have rate hikes or whatever, there's some protection against the rate hikes since the rate on the loan will also increase as well. And these can be held right in a brokerage account. So, but again, they're only offered to qualified investors, but can give you some relief from the swings in the bond market since they're really not traded in that market. They're repriced on a regular basis, usually about once a year. All investments have their advantages and disadvantages. There's no perfect investment. So to get one desirable characteristic, you may have to give up on another one. For example, growth stocks typically don't have much cash yield, or stable, less volatile investments are typically not very liquid, and vice versa. But a well-designed portfolio will have a balance of these characteristics to get to the right balance for your unique needs. They're different for every client. So the conclusion of this short presentation is alternative investments are a way to avoid stock and bond trading markets and the volatility associated with them. They certainly have reduced volatility, and what we use in portfolios to knock down that risk number, which is the volatility of the portfolio, and should certainly be considered as part of a well-balanced investment portfolio. Now, let's see if we can get to some online questions and answers. There should be a little chat button there, so if you do have questions, you can send them. I'll see them on my screen and try to answer them as best as I can. Let's have, and if we do get a chance, we could certainly, sit down and have a cup of coffee or a phone call and talk about this privately if you're not comfortable doing it here. But first question, can you give your website address again where I can find more information? Yeah, we've redone the website. There's a lot of stuff there that might be very, very useful for you. Website address is www.swretire.com. Should give you some guidance on financial issues you should be addressing. And we based it on typical profiles that we see from clients. So you can find the one that you fit in best. There's probably very specific information there for you. So our recording of this webinar will be available so I can review it again. Yes, we will. We'll try to get a recording up as soon as possible on our website and our other social media platforms. I know I speak fast sometimes, so we'll get it there so you can take another look at it. Scheduling individual appointments, discuss my own personal questions and concerns privately. 2 easy ways. Just call our office, 480-812-8640 is a phone number here, and we'll have somebody put you on the schedule. Or you can visit the website. Again, it's www.swretire.com, and there's a place for you to schedule a meeting online there, or just request a conference call. First consultation is always offered as a complimentary service, so there's no charge and no obligation for that. Let's see, can you do risk analysis on my current portfolio to show me where I stand? Yeah, I get this question a lot from clients. Yeah, it's actually very easy for us to do. Our platform allows us to enter in portfolio information manually from your current statements. So if I have the statement from your brokerage statement, I can do that. And then once it's in there, we can do a thorough analysis of risk and return, expected return. And also, once it's up there, it works very well with clients that we can kind of go through it and make recommendations on adjustments that maybe you should consider to make it more in line with your desired risk tolerance and what your future needs are indicated by your financial plan. Minimum investments really depends on the investment program. Usually it's about $5,000, except for the fixed annuities, which is a good way to park money. Those minimums are about $15,000. Qualified investors. Yes, I did mention that. Qualified investor requirements or technical requirements, $200,000 in net worth or $70,000 in annual income plus $70,000 of net worth. There's another category called accredited investors who are eligible for other privately offered programs that we didn't cover here today. But they have to have qualification of $1 million or more in net worth or $200,000 in net income. So let's see if there's any more questions here. Didn't really see any of those. So again, we'll get this recording out as soon as we possibly can on the website and the other social media platforms. And we'll probably schedule another webinar here soon. That topic will be on tax avoidance, always a popular topic. So stay tuned for the schedule on that one. So thank you very much for attending today, and hope to speak to you soon.